Hello, this is Kent Kramer. I'm the Chief Investment Officer at Foster Group. We're an independent registered investment advisor based in West Des Moines, Iowa, with an office also in Omaha, Nebraska. We're privileged to serve over 1,400 investors around the United States, ranging from individuals and families to institutions and retirement plans. And today, we'll be taking a look at the market's response to the coronavirus pandemic and what investors should be considering, especially as uncertainty about the duration of this pandemic continues. Back in February, which seems like a long time ago, these are some of the numbers that were getting investors' attention. After a fairly smooth start to 2020, after a great 2019, markets reached their peak around February 19th. And then between February 19th, that high point, and the end of February, we saw the fastest market correction, which is defined as a drop of 10% or more from a market high ever. In 5 days, equity markets dropped more than 10%. The combination of technology available to us, social media spreading news, and the uncertainty around this global health risk seemed to finally tip the scales as people began to think about that coronavirus pandemic and what was happening with uncertainty in markets. The stock market not only fell quickly, but you also see what happened with interest rates on the 10-year Treasury declining, which is kind of what you would expect. As stock markets decline, generally interest rates decline along with them, causing bond prices to rise. And this is what we were experiencing on the health side, or thinking about the coronavirus at the time, not yet a pandemic at the end of February, but we were seeing it kind of explode in certain parts of China, and it began to surface in Europe as well. We didn't see a lot of it yet in the United States, which I think is one of the reasons why our markets were a little slower to respond. So the current events at the time, or those sources of uncertainty, looked a little bit like this in terms of a list and how they might appear in our mind. The coronavirus outbreak, COVID-19 as it's called, was getting some attention. Maybe it was kind of in a bold type when we thought about it in our head. The other things that were on our list at the time were the United States Democratic presidential primary. There was still slowing or signs of slowing global growth. There are some trade disputes that were not yet completely resolved. And then there is a conflict brewing in Syria as well. Then we got to March, and it kept getting worse. Markets fell even faster into full bear market territory, which is a decline of more than 20% from market highs, and that was in bear market territory by mid-March. Equity markets fell faster, experiencing their worst week since 2008 by Friday, March 20th. At one point, stock and bond prices were actually falling together as investors were selling everything, including bonds and stocks, in order just to get to cash positions. There was just a whirlwind of activity because of the uncertainty and fear that had entered the market. And of course, this is the picture of that fear. Now we had this coronavirus spreading not only throughout China, but well into Europe, and now it was fully taking a hold in the United States as well. And the question was, what did this mean for public health, as well as what did it mean for the economy and where things were going in the future in terms of our personal financial lives as well as our personal health. So that list began to look more like this. Instead of just a small, maybe bold print, now the coronavirus pandemic was red, bold, big print. It was just right in front of us. We couldn't get away from it. Global quarantines were being talked about, lockdowns of entire cities. We got comfortable with the idea of social distancing as the new normal, many of us working from home. The government was announcing all kinds of economic stimulus policies, monetary policy with Federal Reserve banks lowering interest rates, announcing that they'd be buying record numbers of bonds, trying to support corporate credit as well as municipal credit. Still had the idea of slowing global growth. Now it was slowing even more because of what was happening with economies as people were not able to get out of their homes and do business as usual. The other three things there, the presidential primary kind of took a back seat. Trade disputes seemingly less important, and of course conflicts around the world just kind of started to grind to a halt as well in terms of grabbing our attention. Over the years at Foster Group, we've developed 5 foundational principles that we think lead to better investment outcomes. We think these principles are kind of all-weather principles, and they can certainly be applied in virtually any economic or market environment, even one as volatile as the current one. The first bullet point here, our first principle, is really the most important, that investors need to be clear about their short and longer term financial goals before any dollars are invested. The reason for that is any portfolio can only be deemed successful if it meets the actual goals of the investor. The second principle can be a difficult one, but it's equally important. To be successful over the long term, we found that investors need to be able to embrace uncertainty. Now, why do we need to be able to embrace uncertainty? Because uncertainty is just part of our lives. It's not something we like. We'd prefer to have more certainty or predictability because we'd always like to avoid negative experiences or consequences if we can. But uncertainty is just kind of an aspect of living. One of the things that we've seen over time, again and again, for investment is investors are better off responding positively to uncertainty by taking actions to financially prepare for the unpredictable. In this case, a potential global health crisis. No one saw maybe this global health crisis coming, but certainly the idea for investors is there's always going to be unknown kind of negative events out there. So rather than trying to predict which ones are exactly going to occur, let's prepare for those things. Let's acknowledge that the future is a bit uncertain, and that embracing uncertainty will help us not only prepare financially, but it'll also help us prepare mentally and emotionally for when the improbable occurs, because we've already thought about it. We know that we've made plans with some of these negative things in mind. This isn't the first global health crisis that we've seen in the last 70 years, but it certainly is becoming the most significant. So we look at this chart, you can see a number of global health issues that have occurred since the 1980s. On the table on the right, you can see the effect on stock markets after the announcements of that, 6 months going forward, 12 months going forward. What we see with these previous public health crises or public health events is that they had a relatively short impact in terms of their effect on the population. They didn't spread nearly as broadly as the one that we have right now. And because of that, the effect on stock markets was actually relatively benign. If you look at the average price return of the S&P 500 over the 6 months following the announcement of these public health issues, average annual price return about 8.8%. If you look at the S&P 500 over a 12-month period after the announcement, 13.6%. These are in line with historical returns for U.S. stock markets. So what that means is, while they may have had an immediate short-term effect that might have been negative, the intermediate 6-month or the longer-term 12-month effect tended to fade away. I think this time around things are going to look a little bit different because the degree of the crisis that we're experiencing is seemingly so much greater. Financial markets, they just don't respond positively to uncertainty. For many, uncertainty produces fear, and fear can lead to wanting to sell, even as prices have fallen. By early March, before the virus became really widespread, investors were already beginning to sell at these lower prices, and you can see that from the chart here. The blue line represents bonds inside the United States. The dark blue line is the S&P 500, and the orange line represents global stocks outside the United States. So what you can see is stocks are declining, bonds are doing what we'd hoped for. They're providing diversification and support. Early on here, even after that steep decline, by March 2nd, you can see that at midday, stock markets were actually moving higher on that day, and they closed the day up over 4%. So people were thinking, well, maybe things are going to be okay, and this is going to be a short-lived market issue, maybe similar to one of the ones we just looked at. And then March came and the virus began to spread more rapidly. The WHO declared the pandemic, and pretty soon markets really got volatile. As that virus spread rapidly, investors around the world were trying to figure out what it meant for the economy, what it meant for the value of companies. You can see that even bond investors began to get nervous. So that blue line representing the US bond market showed some volatility, showed some declines, because at one point there, everybody was just wanting to sell. They were not wanting to hold any risk asset at all, whether it was stocks or bonds. Those were very volatile days, which is one of the reasons why the Federal Reserve and the federal government stepped in so strongly to support markets and to support those credit markets. Something very similar happened in 2008 as stock markets experienced their deepest drawdowns. Ultimately, U.S. stocks and foreign stocks in that great financial crisis fell over 50% from their 2007 high point, though they didn't fall as quickly as they have in 2020. Historians like to say that history doesn't repeat, but it does tend to rhyme. And while the cause of each financial crisis, whether it's the one in 2007, the tech bubble in 2000, the great kind of fall of 1987. All those things were brought about by different combinations, but the market response was very similar because the market, we as investors, we don't like uncertainty. Rhyming tends to be true in both the drawdown and the recovery, and that's where long-term investors need to stay focused on times like these. You need to remember the plan that's in place, remember the connection of the portfolio to the plan. The portfolio should already have been made of a combination of preservation assets to meet our near-term cash flow needs with things like bonds and cash. It should also own growth assets, which are long-term positions that can be held for 8 to 10 or even 20 years before they would need to be sold. Even in 2008, the worst financial crisis since the Great Depression, you can see that bond values, even though there was some initial volatility there early on in that drawdown period, they recovered relatively quickly and gained over the entire recessionary period. Stocks did go down precipitously, but they ultimately recovered and provided strong growth for investors, as we'll see here in a minute. Embracing uncertainty is important for stock market investors because ups and downs happen every year. Ups and downs like this year seem very extreme, but if we look at stock market calendar year returns, what we can see is the performance of stock markets can be wildly different from day to day and year to year. Investors would do well to consider this kind of volatility in stock markets to be somewhat normal. This graph displays the returns of the S&P 500 index since 1990. The blue bars show the return for the entire calendar year. The black and the red whiskers show the largest gain and decline within each year. Even in years with high calendar year returns, a large intra-year decline may have occurred. The performance for any given time period does not need to prompt action in that case. A long-term focus can help block out the noise. Intra-year gains are measured by the largest increase within a calendar year using the daily total return data. Intra-year declines measure the largest decline within a calendar year using that same daily total return data. Looking back to 2009, the S&P had a calendar return of about 26.46%. However, the largest intra-year decline during that same year, 2009, was 27.19%. So from January 7th to March 9th, the S&P 500 declined over 27%. The largest intra-year gain that same year in 2009 was 69.66% from March 10th to December 28th. So the calendar year return for the S&P 500 in 2009 was over 26%, but investors endured a 27% decline from January 7th to March 9th, and then were rewarded with a 69% increase from March 10th to December 28th. This chart illustrates the historical performance of the S&P 500, highlighting periods when the market was rising and falling. Now, bear markets are generally defined as peak to trough downturns of 20% or greater from the last index high, while a bull market is a rise of 20% or more from the trough through the next new index high. We can see from the chart here that good times for stock markets have been disproportionately longer and stronger than the bad times, and the duration of the bull market run is not a useful indicator of future performance. We expect positive returns in equity markets every day, not because we know what's going to happen, but on average, that is what happens over time. Stocks tend to go up more than they tend to go down. While there's no consistent way to predict when realized performance will be positive or negative, investors staying the course have really been rewarded over the long term. Again, the thing to note in this chart, when you look at those kind of blue mountain periods, is you just see they are longer than the drawdown periods, which are red, and they're also stronger, providing significant positive return for investors. So will the coronavirus lead to a recession? That's a question we've heard a lot lately. It almost seems certain at this point, given all that we've seen around the world. The data is already anecdotally there to support supply chain delays and unemployment claims. Technically, recessions are 2 quarters of GDP contraction. We had been growing at between 2 to 3% a year recently. The thing about recessions is you don't know for sure you're in one until months after it has begun, because it takes a while for the government agencies that collect the data to kind of see it, review it, and then compute what's going on with GDP. So oftentimes we're in a recession for months before we know officially that we have been. Even so, for investors, recessions need not be catastrophic. And again, for long-term plans, they should anticipate them, even though predicting when they will start or stop is near impossible. Even if we could get close to predicting when recessions start and stop, would it really be that helpful for positioning our portfolio? I suppose if we could be precise about it, it would. But let's look at this table here to see really practically how this works. This table gives data on every recession going back to 1957. You can see how much GDP contracted in those periods of recession, how long the recession lasted, and then the time from the end of one recession to the beginning of the next. If you look at the last one on the list, the recession from December 2007 to June of 2009 during the Great Financial Crisis, you'll see that GDP contracted about 4.3%. The duration of the recession was 1 year and 6 months. And then we entered into a time starting in July of 2009, likely through February or March of this year, of economic expansion. That economic expansion, we were 10 years and 7 months into it since the last recession ended. It's been the longest interval since World War II. So people would say, well, recessions are going to happen. We are probably due to have one. What is this one going to be like? No one knew what was going to cause this recession. No one saw the coronavirus coming, but everybody was aware that, hey, a recession is likely. What does that mean for an investor? Well, if we think about recessions and trying to predict things, the time periods we have good stock market data for going back to the 1950s, the stock market has performed reasonably well before and after recessions, but what about during recessions? Look at the recessionary period. What you'll notice there is in 4 of the 9 recessions since 1957, actually during the recession, the U.S. stock market was positive. 6 of the 9 years prior to recession, the stock market was positive. And for the 1 and 3 5-year periods following recessions, those numbers really speak for themselves. You can look at each recession and see the positive numbers associated with each one, but if you just look at the averages on the bottom, you'll see that for the year prior to recession, U.S. stock market was up almost 6%. Then the period during recession, an annualized decline of less than 2% on average. And then the 1, 3, and 5-year periods after those strong returns total. So the question an investor has to ask is, do you want to try and predict when the recession is going to be exactly and try to avoid that negative 1.6% return? Or would you be better off instead just accepting the 6% return 1 year prior, not getting out too early and missing positive returns, or not worry about trying to get back in too late? Because the first year after the recession, you see that strong return of 15.3% for the next 12 months following recession. For many investors who try to get in and out of the market timing things on recession, they miss some very strong months early on at the end of the recession. Actually, the stock market begins to turn up before the end of the recession because it's generally a leading indicator in terms of where economic activity is going. If you remember back, this seems like a long time ago now, this is December 2018, but U.S. stock market later in the year in 2018, the stock market had fallen over 19% from its high point in December. And it was very tempting at that time to think that the party was over and that economic expansion, which started in 2009, was coming to an end. And maybe it was time to get out of the market. But it turned out that it really wasn't coming to an end, at least not right then. For investors who didn't try to predict or fall into that prediction mindset and stayed invested all the way through 2019, they were rewarded with a stock market return of over 30%. The market was up 10% in the fourth quarter of 2019 alone. So here's where we are, or where we were on March 25th, closing out the first 2 consecutive days of positive returns in U.S. stock markets since early February. You can see it right at the end of the period there. But overall, yes, markets had declined significantly. Yes, it's highly probable that we're in a recession that could have begun in early March. But note that bonds, while having experienced some downward volatility, are back to positive returns for the year. The question is, have we seen the bottom of the stock market? Really, only time will tell on that. In a Wall Street Journal article entitled "How Long Might the Bear Market Last?", the authors noted that the average bear market wipes out about 36% off the S&P 500 and lasts for about 7 months. We saw U.S. stocks decline between 30 to 35% in less than 2 months. The likelihood of being at the bottom, or at least through the recession, seems unlikely at this point given the length of past recessions. However, one thing we can know is that for market participants, for investors who stay invested over long periods of time, markets have tended to reward those patient investors. Today's markets are full of uncertainty, as is the global health situation with COVID-19 and the pandemic. In the past, though, long-term investors have been rewarded for patiently maintaining a diversified portfolio of U.S. and foreign stocks, as well as bonds and real estate. It's a reasonable expectation that this time we'll see similar results in the rearview mirror post-virus. Some positive steps that investors should be considering today, though, would include this. Investors could be rebalancing their portfolios from bonds to stocks, moving the portfolio back to its long-term allocation. In effect, using the market decline that we've seen recently as an opportunity to buy some stocks on sale. Investors may also be able to harvest some tax losses along the way, which can help defray future taxes. And finally, if an investor has any questions regarding whether their portfolio is still well suited to their financial plans and goals, setting up a meeting with your advisor to review both the plan and the portfolio can help restore confidence in how a well-diversified portfolio can help meet both your near-term cash flow needs and your longer-term growth goals. For investors who may not have an advisor to meet with, or for those who might like a second opinion, the advisors at Foster Group would welcome both your questions and conversations. In this time of social distancing, we've made it as easy as we can to have a face-to-face web meeting where in-depth discussions can occur, and just know that we enjoy having them. We've put our contact information here for you to get a hold of us. We would welcome your inquiry. We'd love to have that conversation. Again, thank you for joining us today for this conversation. We hope to talk to you in the future, and we'll be back with more information as it becomes available to us.